What's up, gang? Welcome to PGU Invest, where we only invest if the price is going up. Today, I'm coming to y'all with a little bit of information about three ways to invest, right? And so, the first one that we're gonna look at is long term, right? And so, long term investing is commonly, what most serious investors build their portfolios off of, right? And so your portfolios are filled with cornerstone stocks, right? And so these type of stocks are normally stocks that are safe, right? Like your AT&Ts, your Verizons, and different things as such. And then we have our growth stocks, right? And this could be uh, stocks as far as innovation, pharmaceuticals, or maybe even anything healthcare. Uh, or it could be stuff like energy, right? You can have energy, and so you get the point. Like your long term is just a list of things that you believe will grow long term, and some growth stocks that you can look at now will probably be like your Apple, um, you know, Tesla. What's another good one? Oh, my favorite one. How could I forget? Facebook. So those will be some of your growth stocks, right? And these are stocks that you buy now. Oh, another good growth stock, which is a ETF, is ARK. ARK is down right now, around $99 or so, I think. But I may be wrong. But I know it's dropped below $100. So these are your typical growth stocks, right? And ARK K is an innovation ETF. And right now at this value is very, very good to buy into it, right? Apple is highly, highly undervalued right now. They've experienced stock splits many times before. So now to get them at their current price would be, very, very good. Tesla, good stock to get right now because, you have analysts that's saying that it's going to get around $3,200. And so you definitely don't want to miss out at the price that it's at now. You want to kind of average in, and as it decreases, just get your average down. That's what I would do at the current moment. And Facebook, right? Facebook is big with the ads and everything that Facebook is investing in. I even heard that they might be trying to do a watch for their like a Facebook type of watch, kind of like the Apple Watch. And so some of these are just some good growth stocks, as well as they could be cornerstone, right? I would look at Apple as a cornerstone stock. It's not a stock that I would really worry about in my portfolio. So cornerstone is those stocks that you kind of just put to the side and that you don't really have to worry about, even though they have fluctuations. You know that it's a good, valuable stock. So we have that one. We have our long term, right? And so, like I said, long term is just stocks that we're going to buy and hold. We don't have a time limit on them. We're just going to hold them until it no longer makes sense. And so, our second type of investing, right, is swing trading. And so, this is just when you buy shares and hold them for a certain return, right? So let's say you buy, I don't know, you buy 1,000 shares of something, right? And you buy this 1,000 shares, let's say you buy them at $5, right? And you say, well, I'm gonna buy 1,000 shares at $5. So how much money are you gonna spend? You're gonna spend $5,000 to buy this amount of shares, right? And you say, my target is I want to hold these 1,000 shares until they hit 750, right? And therefore, what do you expect if you're holding these shares until they get to 750, right? That means that you want a 50% return. Okay. So, when these shares hit 750, you're then gonna have 1,000 shares at $7,500, and so your profit is 2,500. And so a lot of people like to do that, and you can swing trade shares. I don't know, it might take a couple of months for some. Some you might buy into, and it'll take a couple of weeks. So I will say that swing trading and long-term investing is probably the safest way to go if you're buying stocks, that are good stocks. You just can't buy any stock and think that you're going to get a return on your investment, right? You have to do your due diligence. You have to find out about the company. You have to look at their balance sheet so that you can see if you're buying into something of value. That's the key, right? And so our third type of investing, right? And this is the most riskiest type of investing that you can do, right? And it's options trading. And so a lot of people don't know what options trading is. But options trading gives you the right to buy or sell contracts, right, at a premium. And so these contracts, right, one contract equals 100 shares, right? And you have the right to exercise these contracts. So if you were ever to exercise a contract, you would say, okay, let's say that your strike price, which is the price that you are saying that the stock is going to get to, right? And so it's two types of strikes, right? So you can have a call on it, and you're normally betting that the price of the stock is going to go up, right? Or you can have a put strike on it, in which you say that you're going to buy these, stocks at a strike price that has decreased below its current share price. And so one contract, right, gives you 100 shares of, you're saying that the stock, okay, let's say that the share price of this stock is at $30, right? You're saying that the share price is at $30. So if you wanted to have a call on this and you say, I'm going to call this going to $32, right? That's a call because the price is going up from its current share price. And then so if you have a put, right, you would say, I'm going to put that this stock goes down to $29. And that's the put because the price decreases from its original share price, okay? And so, first of all, you should know that when you're buying these contracts, right, all of them are at a premium. And since you have 100 shares per contract, you might see a premium. Sorry, guys. You might see a premium at 0.30, right? And you're like, oh man, 30 cents, this contract is pretty cheap, but that's not right. You're going to have to multiply it times 100, right? Because if one contract is 100 shares, and so you have to multiply your number of shares because this is your premium for each share of that contract. So guess what? The contract is $30. $30. And so I guess a lot of people say, why should I deal with options, right? Well, a lot of people like options contract because of its potential, right? So you can have a small buy-in and experience big gains, right? And this can occur whether you buy a call or a put, right? So like we said, if you're buying a call, then that means you're rolling with PGU because the price is going up, right? And if you're buying a put, well, you're not a bad person, but you're betting that the price is going to go down, right? And so, for example, I'm going to give you guys an example, right? So, we have this stock, right? And the share price currently is $15, right? And the premium on this contract is 20 cents, right, per share. But we know a contract has 100 shares in it, so we have to multiply it times 100, and that'll give us $20, right? And so we say we're gonna buy a call at $22, right? And so how much money can we make off of buying this $20 contract, right? And another thing that you should know is every contract has an expiration date. And the closer it gets to your expiration, the less that it's worth. Okay. So closer to expiration, the value of the contract goes down, right? And we'll get more into that on another video. But anyway, so we have our share price right now is currently $15, but we're gonna have a call price to say that this stock is gonna go up to $22. And what you should know that even though you say that it's gonna go up to $22, you can sell if you're in a profit, right? So let's say that you have a call saying that it's $22, but it gets to $20 and you want to sell. That's perfectly fine. Your premium has went up, right? This contract is really valuable. So let's see what our profits would be if this stock price got up to 20. And guys, this calculation that I'm about to do, it isn't necessarily correct. It does give you a ballpark of, you know, what your profits could be. You have to understand that you have a lot of factors that play into, you know, the premium on this options contract. And so you have your implied volatility, and then you have your open interest, and then you have your volume, right? And so we will talk about these three in another video, but you got to understand that these three are major players in how much your options premium will be, you know, and that's essentially how much money you'll make if the price is going up. So we're gonna just do a ballpark calculation right now. If we bought a $15 share price, if we bought a $22 call on it, but we're gonna sell it at $20, right? And so we gotta remember our premium. So what we're gonna do is we're gonna say 20 minus 15, and then we're gonna subtract that 0.20, right? And so we got 5 minus 0.20, which gives us 480, right? So our premium is what we paid our broker to let us buy this contract. And so we have to subtract this from our profits because it's money that we pay to buy in. And the thing with options is you can gain a lot, right? But the most that you can lose is the premium that you paid on that stock. So y'all looking like, oh, $4.80. No, you remember, we gotta multiply it times 100, right? And so therefore, we've made $480 off a $20 contract. And so I guess that explains why a lot of people like options. But like I said, options is very risky, very, very risky. And it's not something that you can master overnight. But before I go, I will say this, right? Because I don't want to leave anybody like thinking like, hey, I'm gonna do options tomorrow and no little advice on it, right? I mean, and this is not financial advice. This is just pretty much my opinion and my perspective on it, all right? So when you're dealing with options, the best thing you can do is buy time. And when I say buy time, that means you want to buy a far out expiration date, right? It's better if you buy your strike prices, like if your strike prices is closer to the share price, right? And when I say that is, if right now your share price is $19, you will probably be more safer if you're buying time if you were to buy a $20, strike on that, a call, $20 call. And you want to know how to cut your losses, right? And so normally a rule of thumb is if you haven't learned how to do technical analysis to a point where you can know if you could get below 30% and be able to get a return on your investment, then I highly suggest that when you get down to negative 30% on your investment, that you sell and you get out. It'll always be another day to invest. But yeah, guys, I just wanted to drop a quick something for y'all so that, you could get a little perspective as to, the various types of investments that they have. But hey, we know one thing all the time: price is going up. Thank y'all for tuning in to PGU Invest, where we're gonna build generational wealth and buy back our freedom.